Coming back for the results of February, I think, and I've written about this a couple of times already, and I think I might have caught investors' attention at the very least, in that I've said that 2021 will basically everything that smells like a risk asset will operate under the cloud of the bond market this year. Now, why is that? Is that bond markets is very simple. It's the best comparison I still think is with the oil market. When oil rises initially, that's seen as a good thing by investors because it means economic growth is there. There's demand, and the oil price rise is seen as a good development. And if oil price continues to rise, then there comes a point where it becomes a negative, and then the markets start paying attention and possibly even correct lower or worse. The last time I remember when oil was a major impediment to a bull market was in 2008. And we probably will remember that oil went very quickly from 70 to $136. And a few months later, we were all in the deep bear market. Now, the bond market works around the same principle. And the reason why bonds go up this year is the same reason as why we have a bull market in equities and risk assets. The world is looking forward towards an economic recovery, and that's all positive. And so we will get more demand, more growth, we will get more investments, we get more spending. And that also means we might get inflation. That's still a big discussion point. I'm not amongst those who are predicting a strong comeback of inflation. But what is possible, because we are talking financial markets and we have lots of different views and different approaches, is that we will get conniptions along the way, and that is almost by definition means we will get inflation. But I mean, we get volatility. And if there's a little bit of a smell of inflation, the markets will respond, and we get all kinds of crazy stuff going. And in particular, if the bond markets would rise rather quickly. Now, I've used this previously, that according to modeling by economists, the bond market should, all else being equal, probably be around 2% today. And in most developed economies, they are like 1.18, 1.2-ish. That means if bond yields would move to 2%, we would see a humongous correction in share markets. So I always say to people, let's hope we don't get there. But I've seen forecasts that bonds will go to 150, and that in itself will cause problems for at least for segments of the share market. So we should be aware of that as investors. And the ones that will get a little bit in trouble because of it, they have already shown that they are facing headwinds. And the obvious ones are the likes of CSL, car sales, Zero, Appen, ResMed. You can also put in Coles, for example, Woolies. You get the defensives, you get the quality stocks, you get the structural growth stocks, you get the technology stocks with a large runway, structural growth. They are all impacted negatively if bond yields rise. Now, which ones are the ones that benefit? The ones that benefit are predominantly the banks, because the banks, in particular, if short yields stay low, high yield, the long yields go high, the difference between that is free profits for them, essentially. So in this environment, it should not surprise anyone that the banks have made a comeback in Australia, and they probably will continue making a comeback if this environment continues, which for the time being looks like it is. And of course, I touched upon it earlier, the REITs, the dividend stocks. And here now, I think it becomes important for investors to either take a view that after a rise in bond yields, that will be it, and then you can compensate for the loss in share price through continuously receiving your dividends, or the better way might be to shift your strategy for income towards industrials and financials that will grow their dividends. As with everything in the share market, the best cure for headwinds is growth. And most of the REITs, most of the property developers and the owners of property assets, they don't have much in terms of growth under the belt. So they will see a reset in their share price. If you look at price charts for the likes of Charter Hall, Longwell, Charter Hall Retail, the Centuria Industrial REIT, for example, they've all reset to a lower level, APA Group example as well. If bond yields, we all should be aware of that if bond yields rise further, that reset will go to a lower level in share price. So you will basically lose more on your capital in the immediate outlook. Now, nobody knows how quickly that goes and when that goes, but we all have to realize that if the bond yields continue rising, then those stocks will go nowhere. They will still pay out their dividends, but share price wise, you might lose in share price what you might gain for the income. So the best, and this is one of the reasons why I reallocated or decided to reallocate some of the money that I co-manage, is that it's better to go for industrials and financials. February, the reporting season that's coming up, is probably going to see the big return of dividends, and in particular August later in the year. And that means that a lot of companies who have been cutting dividends last year, including the banks, will be raising their dividends this year, and that by itself means that those stocks will perform much better. There are also stocks which I believe are very much insulated as well from higher bond yields. There's a Telstar, for example, and you also have retailers, Super Retail, for example, and many others offer you robust growth in combination with very attractive looking yields. Those stocks will outperform the simple bond proxies in the share market. Now, another problem that we have in Australia is that the currency has appreciated quite a lot, and that of course is also going to have an impact. But the question has to be asked whether that currency can go a lot higher from here, and whether that impact hasn't already been priced in many stocks. For example, the retailers are often mentioned as beneficiaries of that, but there's a long lagging effect about when those advantages actually kick in for retailers. In similar fashion, it also takes a while, often, for the disadvantage to kick in for a weaker currency. I think that the main problem this year for a lot of investors is that literally the dynamic in 2021 looks like it will be the opposite of the previous 5 years, 5, 6, 7 years. And that means that the super stocks, the super performers from the past 5, 6, 7 years, the CSLs, the WiseTech Globals, the Appens, the Altiums, the Zeros, a lot of those stocks, the car sales and etc. In many cases, those stocks are now facing headwinds, and the market has found this is still a polarized market. It's very much dependent on momentum in the moment and on sentiment from investors, and that means that those stocks, even though they are still growing and they may not be doing anything wrong, they are facing headwinds this year, and the share price, of course, it doesn't have to sell off by 20%. In many cases, it has already happened, but they will probably not keep up with the gains that are can be had from the likes of the banks and many of the mining stocks, and probably in the immediate future also the energy stocks. Where the problem comes in for long-term investors, as I'm hoping you are and as I am, is that the big question mark is for how long this shift in momentum can and endure. And if we look at the past, it usually lasted maybe 5-6 months, and then it would switch back. It is possible that this time it will last longer. It's all dependent on how strong and how sustainable this economic recovery will exert itself. I have a suspicion that it will not be as straightforward as the bulls in the market at the moment are forecasting, and that's why I think it's probably fair to say we will have a lot more volatility coming towards us. And that volatility will constantly see the market making a switch, in a very simplistic sense, from BHP, Rio, and ANZ and Westpac into CSL, ResMed, Appen, and Bapcor, and vice versa. And so the reason why, there's two reasons why in January. I thought it was best to warn everyone that it was getting a little bit hot under the collar in share markets. And the reason why I thought it was very prudent to take some money out of the market and reallocate this. First of all, as with everything, it's very difficult to pinpoint when a market gets overheated and what then subsequently will be the consequences of that. I think we saw a little bit of conniptions in January, but as this reporting season draws very, very near, we can't correct, because the reporting season, as I've written today in my weekly insights, it looks so positive, both in the US as here in Australia, that the market would find it very difficult to correct to lower levels. So we just have to see whether how long that momentum can be contained or can remain in place. It's very difficult to not side with the old guard that has been complaining now for quite a while that these are markets on fumes and way too expensively priced. I disagree with that, but the problem is there are pockets left, right, and center, and in particular in the United States, that are just sheer craziness. And you can see how that makes people nervous. It makes me nervous at times. But I guess we all have to realize that the times really are different. They're not comparable to the year 2000, if only for the fact that we have much lower bond yields. And they do have a major impact on how assets are priced. But we should always be aware that, and this is very important to keep in mind, I think, we should be aware that in the 1930s, at the end of the 1920s, the average PE in the share market wasn't that high, not as high as we are led to believe in the subsequent decades. Yes, of course, there was always crazy stuff going on. But in general, PEs were not higher than they are today. They're probably lower on many accounts. What defined the bear market that came after that is that the forecasts were unsustainable. So what was priced in the shares was unsustainable. And that is the big question mark that you get with markets like today. For example, discretionary retailers are absolutely shooting the lights out. They can't believe how much cash comes their way. Now, in many, many cases, that leads to share prices that are not as expensive as they look like on face value. But the question mark is, how long can that momentum continue? And for example, I see on a regular basis, I see reports where analysts will tell their clientele, this is sticking for longer than you might think. Which means that what looks today as a rather bloated share price for the likes of JB Hi-Fi or Harvey Norman, effectively isn't. And if we would continue this for a year, then the big question mark would always be, but is then the next step that their sales will fall off the cliff? If the answer would be correct, that means that the share price by then, of course, is way too expensive and has to correct. If the answer is no, and we don't follow necessarily the momentum throughout the rest of the year with a further increase in PE ratios, then there is no need for a new bear market to continue after that. But that's, of course, goes a little bit beyond the fact that we are humans in the market, and humans, you know, us, we always complain about machines, but you basically can't trust us, all right? We are the ones you can't trust, and that is, I think, that's the fine line we will have to work with in 2021. As far as the reporting season itself is concerned, I mean the signs are very, very good, in that the first reporters we've had, from ResMed to REA Group to Credit Corp to Pinnacle Investment Management and a few others, they've been very good, much better than analysts' expectations are, and that's probably typical for the early stage of recovery where we are. The only problem is that the sentiment in the market doesn't treat all the stocks in a similar fashion. And what do I mean by that? It's basically what I already explained earlier in the difference between the car sales and the MCORs and the CSLs versus the CBAs and the PHPs and the Fortescues. In the US, for example, and I'm not quoting Macquarie research, but I thought that was very, very remarkable, is that in the US, 80% of the COVID winners, which is basically those companies who have performed really, really well last year and who are in a strong position, they have beaten market expectations so far. But only half of the number has done it amongst COVID losers. So about those companies that stand to benefit this year from the reopening. Yet the market has rewarded the COVID losers much more and much more clearly than the COVID winners. And I think that is the story for 2021. And if that is being repeated in Australia, I think that the victims, maybe stocks like Vicinity Centres and in Instant Pivot and the banks, of course, and in QBE, for example, they will get more credits from investors this year, even if they might disappoint a little bit. And the likes of MCOR and the CSL and the ResMed, they have to work much harder to potentially get a lesser reward for the work they've done. And that, unfortunately, for the time being, is the story of the share market. And I hope that you can all incorporate that in your thinking in how you start observing the share market. What I basically have advised to do with the all-weather portfolio is to take some money off from the COVID winners from last year, and we made some really good profits on Fisher & Paykel Healthcare, on Nanosonics, and on a few other ones. And we basically reallocated that in stocks that we thought are going to do better in 2021, given the different emphasis and the different accent that is this different focus amongst investors this year. And of course, we don't go massively in banks. We don't buy mining service providers. We don't buy mining stocks. That's not what we do. But we've chosen stocks that we think would be a better momentum play, if I can call it like that, in this year. And we've added money to the likes of Aristocrat Leisure. We've also added money to Technology One, and that gives you also a little bit in our thinking. Some of those technology stocks, they become too cheap at some point, and then it becomes a good entry point again. And we've also added stocks like an IDP Education, which has rallied very, very hard. We didn't think it would go that quickly. We've also added super cheap for the reasons I already laid out. And for the first time in a very long time, I'm actually convinced that 2021 might actually become a year of not only the comeback of the banks, but also of Telstra. And so to change our focus with dividends, we've also added Telstra as a full member of the portfolio. I hope I have touched upon most of the questions, but in case that's not the case, we'll do this again after the reporting season. And in the meantime, feel free to leave messages. I'll do my best in answering them as quickly as I can. Thank you all for attending, and we'll do this next time. Bye-bye.